We are here today with Tom Reeg, CEO of the world's largest casino company, Caesars Entertainment. And Tom, let me start by saying you might be the busiest guy in the world. I mean, this year you have completed the biggest casino merger ever. You have you're integrating that merger. Before the dust settles, you are proposing a acquisition of William Hill. And you've done all of this during the greatest pandemic in more than a century. So my question to you is, what do you do in your spare time?
I try to see my wife once in a while and my kids. We wouldn't have drawn it up this way to have to do all this in the middle of a pandemic, but you can't control when the opportunities present themselves. And we were fortunate to be able to get the Caesars deal closed in extraordinary circumstances with the public health situation. And the opportunity is so immense in terms of online sports and casino. It's important for us to control our own destiny. So we thought we needed to make a move there as well.
Well, and we'll cover all those topics. Those are all key topics. Thanks. You've had a little bit of time now to dig into Caesars firsthand. What surprised you so far?
There's not a lot that surprises me after as many acquisitions as we've done. I would say the focus on revenue to the exclusion of profit at Caesars has been opening. You know, when you do an acquisition, the target company then puts you on all their reports and sends you what they're looking at daily. And everything that I was receiving was a revenue report. There were no tracking of costs. And we track our EBITDA by property daily. In Legacy Eldorado, that's the case in a lot of the operators I admire in the business. Bill Macbeth at Cosmo, Jay at Penn. I think you need to know where you are as often as possible. And I don't really think Caesars knew where it was more than, once a month, which is a hard way to run an $11 billion business.
Yeah, that's kind of an interesting observation because on one hand, you've made the point that you are going to give back a lot of empowerment to the property level people and not micromanage from a corporate headquarters. And yet on the other hand, you're saying that despite that sort of structure, they weren't really aware on a daily basis what was happening operationally.
Yeah, I mean, you track what's important to you. What was important to the former Caesars was tracking primarily revenue and market share. And our focus is EBITDA and free cash flow. And I think if you give management the tools to track their business appropriately, everybody wants to figure out how to do things better, how to make more money. They really weren't getting the tools within Caesars, despite as much as they had centralized, to really look at their business every day and say, how can I be better today than I was yesterday?
You had a lot of ambitious goals to achieve in the acquisition and integration of Caesars. Some synergy goals, cash flow goals, balance sheet goals. How do you see yourself as on the road to achieving those?
So our synergy exercise was turned on its ear with COVID. We had announced a $400 million cost synergy target, $100 million of revenue synergy when we originally announced the deal. COVID sweeps the country, ended up shutting down 54 properties across a combined enterprise, and $3 billion of labor came out of the system. So now it becomes more of an exercise in figuring out how much of that comes back versus what you're going to remove from the operating business. And, there are pieces of the business that I think are certainly unlikely to come back in the near to medium term, and, in disciplined companies may be unlikely to come back at all. And I'm thinking about, buffets outside of properties that have multiple thousands of hotel rooms, or the significant promotional giveaway that gathers a crowd on a Friday or Saturday night. You've not been able to do those things in the current public health environment. And as a result, you get to see what your business looks like without them. And lo and behold, it's more profitable. So I think that we've been doing the removal of subsidies on an incremental basis in our legacy portfolio, and as we brought new assets into the fold, I think that's pace has clearly quickened. And I think that the difference is the entire sector got to see what happens. What does your business look like without all the subsidies that you thought you couldn't live without? And we're seeing companies across the regional landscape report improved EBITDA margins, despite lower revenues, which should be eye-opening for the whole space.
Right. Yeah, that's certainly a story we've heard from other operators, as you know. So I guess this kind of wraps up maybe the COVID portion of this. But I get the impression then that what you're saying is that you expect these improved margins and these cost savings are going to be one of the good results, as it were, good byproducts of the COVID experience.
Yeah, I think that the cost structures, I can speak for Caesars, it will be sticky as the world reopens. I would expect varying levels of stickiness across the industry, but I think there are structural changes that have taken place in the business that are going to make operations more efficient. And when the public health situation improves and the world truly reopens, I think the flow through is going to be enormous.
Right. And help get that leverage ratio down.
That's right.
One of the things that talked about also in advance of the merger was the probability of selling some Las Vegas properties. Has COVID in any way delayed that, or is that still something that's going on about the pace that you had expected?
So as you'll remember, Frank, the Vegas asset sale was discretionary for us. It wasn't a necessary sale. It was something we want to do to improve the health of our balance sheet, reduce debt, reduce our dependence on a single market. A couple of things have happened that impact the timing. We were intending to have a sale negotiated and announced in the first 12 months post-closing the transaction. If I had my crystal ball today, I'd say that probably is kicked out by 6 months. I don't want to be marketing a Vegas asset where I have to market through the complete absence of group business here in Vegas today. I'd rather see that come back. So I'm talking about what we're actually doing versus what we think we can do when that business comes back. And at the same time, Indiana, from a regulatory perspective, required 3 asset divestitures that should get us substantial proceeds that will reduce debt and improve the health of the balance sheet. And those should announce and close on a similar time frame as the original Vegas asset sale. So I think that we can still meet our balance sheet goals and ultimately sell the Vegas asset in a responsible manner for our stakeholders.
Very good. The the William Hill acquisition, and you had mentioned earlier in your comments about Caesars controlling its own destiny. Can you tell us a little bit about what you hope to achieve uh, with the William Hill acquisition, and perhaps in quantify in some manner the opportunity that is there in online gaming and in sports betting?
So I'd caveat the remarks on William Hill by saying the UK takeover laws are extraordinarily strict, so I have to be careful how I speak of it. But the William Hill partnership we put that together at Legacy Eldorado. And as you'll remember, our view was we had the access to the map through our existing licenses that was going to be of enormous value to those that were pursuing a nationwide strategy, but we didn't have a brand that was going to be able to resonate on a national basis. So we were looking for someone that we could partner with that would let us share in the upside that they had in terms of building a nationwide presence on the back of the access that we could provide. And that was the structure of the original William Hill partnership. Well, as events developed, the Caesars acquisition came onto our radar and we executed. That was not in the plans when we cut the original deal. Caesars does bring with it a global brand that certainly can build a nationwide leader in the space, brings with it significant sports partnerships with the NFL and ESPN, among others, and importantly, brings with us the Caesars Rewards database to tie it all in. So where we want to get to from a customer perspective is a single wallet solution where you can earn and use points both online and offline, however you choose to wager, tied to a single wallet and tied to your Caesars Rewards account. We think this provides significant acquisition costs, customer acquisition cost opportunities, and also positions us well for stickiness with our customers. They have their relationship is tied to their rewards account, where we can offer a broad array of methods to earn and use points. So that's where we want to get. And the current partnership structure was not set up to get there. So we had to figure out a way to restructure that partnership. And looking at the opportunity and the growth opportunity, I've said publicly numerous times that this is the most exciting growth opportunity in this space since riverboats were legalized in the 90s. And we think it's important to control our own destiny. And in terms of market size, I would just point to the third-party reports out there where the size keeps growing. The last two that I saw from Macquarie and Goldman both pointed to stabilized market, well in the future, in excess of $30 billion. So the opportunity to control our own destiny here, part one, and part two, provide the customer experience that's going to allow us to accumulate market share is what made the William Hill acquisition attractive to us.
One thing we've certainly learned in the last year or so, whether it be COVID or whether it be taking advantage of opportunities that arise, is that you can't really predict the future. But if you could take that crystal ball out again and look at the world in 3 or 4 years, what kind of company will Caesars be in several years?
It will be a domestic-focused company focused on its existing portfolio. Danville will have opened by that time in Virginia. Beyond that, in the US, it would be surprising to me that if there would be material and new properties at play. I think you'll have seen some of the smaller assets in the portfolio likely have been pruned. I think you'll see a balance sheet that we have a blue chip portfolio and income statement at this point. I think in 3 or 4 years, we'll have a blue chip balance sheet and should be generating tremendous free cash flow. And I think you'll have seen the sports and online opportunity continue to develop as new markets come online. And I think you'll see that there will be multiple winners in that space, and we would anticipate being one of them.
Tom, that's a great overview, and I want to thank you for being as gracious and generous with your time. A final question, and you've touched probably upon some of those points, is what do you want investors to best understand about Caesars Entertainment?
I want them to understand that we are focused every day on driving value for our stakeholders and now being a leader in the business. You mentioned in the beginning that we're the largest domestic gaming company around now. We're one of the largest in the world. We take that responsibility seriously. We want to be a leader in all areas here. Caesars, I know you remember, and I remember a time when Caesars as a brand was unmatched, and from a talent development standpoint and a place for employees to work, it was the gold standard in the space. And they've had a rough go of it for the last dozen or so years since the LBO, but that company is still here within what we've put together, and it's our job to bring it back to where it was and become a leader in the space in every area, from shareholder value, from employee acquisition and development, from diversity, every area where we can be a leader, we want to lead.
Very good. Again, Tom, thanks very much. Very informative discussion.
Thank you, Frank.